Hello, chart watchers, and welcome to this Thursday, August 1st, 2019 Market Watchers live show with your host, Tom Boley and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Taking a look at the market action today, the day after the Fed, we got markets bouncing back. Dow Jones Industrial Average currently up 262 points. The S&P 500 up 29. The NASDAQ up 121 points. And the Russell 2000 again trying to bang up against that 1600 level, currently up 11 points. 10-year Treasury yield ever since the Fed ended its meeting yesterday and announced a 25-point basis cut. You can see we have seen lower yields on the 10-year Treasury yield. We've been dropping. We're down probably about 9 or 10 basis points from where we were when the Fed announced. We are currently at 1.96%, testing that early July low. Volatility index shot up yesterday with the Fed announcement, but has come back down quite a bit today, down 13%. Technology bouncing off of its 20-day moving average, leading the market today. Energy lagging. Crude oil, I know earlier today, was down more than 1%. And you can see the XLE once again testing this gap support level. Software regaining some of its leadership, certainly helping the technology group. And despite energy having a rough day, renewable energy continues to perform extremely well. Another huge move to the upside on renewable energy. We're also having a strong day in the specialty finance area, toys, and home construction with those lower yields. Within the renewable energy, another company coming out with big numbers, SunPower, SPWR. Actually, the numbers on the surface didn't look nearly as great as some of the others within the space, but the market reaction has been powerful to the upside, up more than 34%. And then in that software space, number of big names came out with good reports. One of them, Shopify, beating and raising estimates. You can see Shopify up 29 points today, which is up roughly 9% on the session, breaking out the new highs. All right, Erin, it is day one after another Fed gaffe, in my opinion. Don't even get me started. I've been so, I don't know, put off.
At least they're lowering.
Well, they're lowering, but they're not acknowledging anything. I mean, it's like they make these, they go against the bond market. Bond market's been suggesting now since October that they get on this rate cutting campaign. Mm-hmm. We're seeing it across the globe. ECB, the European Central Bank, has talked about it. They're going to be lowering. The problem with the Fed, if they don't lower, it's going to strengthen our currency. It's going to lower commodity prices, and it's just going to start this spiral of disinflation, which the equity market doesn't like. So we're at max employment, but it's not just employment that the Fed should be looking at. They look at price stabilization. And so it makes sense to lower and to be on a rate lowering path as long as inflation is below their target level. And I don't understand why it's that hard to say that, but I think the disappointment of them not saying it sent stocks spiraling lower yesterday. And this is the third time now in about 8 or 9 months that the Fed is behind the curve, and they're just waiting to give the market what they end up giving them anyway. But never mind.
It's like that, yes, you have to drag them. It's like, come on. Yes. And it's tough though, too, I would say, because there's the politics involved as well. And so, they need to, if they're going to do it, they need to definitely give you the kind of information you need on the back end.
Well, I mean, the Federal Reserve is independent. That makes for great headlines. It makes for great headlines to talk about the White House. The White House has nothing to do with this. If anything, I think the Fed is trying to flex their independent muscles because the White House keeps talking about lowering rates.
Yeah.
They're going to say, well, we don't know yet.
Right. Well, they want it to look like they have nothing to do with the politics, which they're not supposed to. So anyway, we could go on and on about this, couldn't we?
I could go on and on for the rest of the show. And we've got a great guest, Roman Bogomazov. Roman, how are you doing today?
I'm doing really well and so happy to be here. Thank you for having me.
Do you have any thoughts on what the Fed did yesterday? You want to increase my rant? Or?
I'm going to show a trade that I did around the Fed announcement. In my presentation, that's number one. I thought that they either had not to do the 50 basis points cuts right away, or just don't do this and delay this maybe a little bit into like September. But 25 basis points is just neither here nor there.
Yeah, I would have loved a 50 basis point drop, and I think the market would have too, because to me that's taking direct aim at that lower inflation number. But anyway, we could talk about this forever. I know you got a great presentation and we want to get to it. So hang in there with us for about 10 minutes or so. We'll get back to you, Ramon.
Thank you.
All right, Erin, what do we got?
All right, upcoming schedule, seasonality, you're going to be doing that tomorrow. My dad will be here on Wednesday of next week, followed by John Murphy. And then look, the following week after that, we have Dr. Alexander Elder and Julius de Kempener. I would have to say we have a lot of tech titans on their way to the show. Today, we do have Roman. He is going to be giving us his market update and what he is seeing. Talking technically today will be on divergences, and 10 and 10, the first symbol will be Triton International, TRTN. All right, let's get it started. I know we've got a ton of earnings reports to talk about.
Yeah, we got a lot to go over. First, we'll go over the economic reports, and you can see on your screen there, initial jobless claims came in a little bit better, or actually a little worse than expected, I'm sorry. 215,000 versus 214,000. July ISM manufacturing index, lower than expected, but still above 50. But still, it was a miss. And then June construction spending, very, very weak. Minus 1.3% versus an expected rise of 0.3%. Keep in mind, a lot of these home building reports come out with quite a lag. I mean, we're now in August and we're talking about June construction spending. But nonetheless, it was a negative headline. And I just think that the Treasury market is once again going to send a message to the Fed that they're not done. And if you look at what's happened since yesterday, this is just a 2-day chart of the 10-year Treasury yield. At 2 o'clock yesterday, the announcement came out, quickly moved down. We had a knee-jerk reaction back to the upside, and then the selling has continued. Well, not the selling, the buying of treasuries. The move down in the yield has continued. And so as far as I'm concerned, I think this is an exclamation point now that the Treasury market is sending to the Fed that they're not done. Back in December, they came out and said, we're raising rates, even though Treasury yields had been dropping and the market was saying, you might want to start thinking about a cut. They raised, and then they went on to say that, hey, we're going to raise rates 3 more times in 2019. And then they backtracked and they said, well, never mind, we were wrong. Then they get to April and May, and we have another meeting, and they say, well, the drop in the inflation rate is transitory, short term. And then they come back a month later and say, well, it's a little more persistent than we thought. We might have to cut rates. And then, of course, they come out today, yesterday, and they say, all right, we're going to cut a quarter, but we're not sure about what we're going to do going forward. And if there's one thing the stock market does not like, it's uncertainty. And the Fed gave them a spoonful of it yesterday. Anyhow, let's go into earnings reports. A number of companies reporting. You can see on your screen, a little mixture, some up, some down. Royal Dutch, big miss there. But of course, it's in an area of the market that has not been performing well. So I wouldn't have expected too much out of that group. Down at the bottom, though, you can see Shopify, big report out of Shopify, beating by a wide margin, raising guidance, and another huge move there in a stock that, of course, is in the software group, which has been doing very well. But I'm going to start off looking at SunPower because this was one in the renewable energy space. And you can see the huge move here. First, we had one back in June, had another one again this morning. And look at the relative strength, the build in relative strength here over the last 2 months in this stock relative to the renewable energy space, which is already on fire. So now you've got one of the hottest stocks in one of the hottest areas, and it's just absolutely blowing the S&P 500 away. And here is renewable energy relative to the S&P 500, quite strong. Pulling up Shopify. Shopify, of course, in that software space, software making another big move today. Here is Shopify making a breakout. You got a double top here at 340. I think it's a sell if we fail to break out. If we come back down, we opened at 334, so we did not get the breakout on the open. If we leave a long tail up there to 350 on heavy volume and fail to break out, I think short term we probably have a top. Maybe this is an ascending triangle. We go down one more time back into the 310, 320 area. I would watch the close, big volume. So I think where we close today here is going to be important. But what I would take note of is that Shopify right now is breaking out to a new high versus software, and software continues to be in a nice uptrend versus the S&P 500. So really good action there. I mentioned Royal Dutch. Let's pull that up and take a look. Here you can see the stock gapping down, moving down to about a 4-month, 5-month low, testing a key area of support established all the way back in March. The stock had been one of the better stocks in its industry group, but last 2 months has been trending lower again on a relative strength basis. And look at it relative to the S&P 500. So even though it's been a pretty decent performer within its group has been horrible. So as a result, Royal Dutch, even with a little bit of outperformance for a while, is still at a 52-week low now versus the S&P 500. Got to be careful there. All right, I'm going to move on to the dashboard. And I know one of the stocks, it's still here, AJRD. This is one that was very strong, but I'm going to focus, and that was a defense stock, by the way, but I'm going to focus on McKesson, MCK. And McKesson, I think I have it set up here with the scooter and all. You can see McKesson, with its scooter moving up, is now at about a 52-week high in terms of its scooter, and it's breaking out. And the thing that I find really interesting here is if we go over and we take a look at the relative chart, pharmas have not really been a great area versus the S&P 500, but McKesson has been a very strong performer within the pharmas. And as a result, we got a great report. We're gapping up, trying to make a breakout. So if I was to get into a pharma stock, I want to get into a stock like McKesson because it is a relative outperformer. So I'm not shocked by the move, and that is your scooter mover of the day.
All right, time for a couple of upgrades and downgrades. I'm going to go ahead and start with an upgrade for you on Spotify. Spotify was upgraded today by Loop Capital from a sell to a hold. So they have moved it into more of a neutral position. What I'm looking at right now is a really nice breakout here. Let's make this a pretty color. Let's try pink. All right, there we go. So if you look right here, there we are. That's where we're looking at that short-term support being busted, and we're seeing a move away from that. And I really like that, and it comes on the heels of currently of a 5,200-day EMA crossover. So I like the look of that as well. You can see that the PMO, let's go ahead and I'll move that so you can see it a little better, is rising. We've got the PMO buy signal that came in above the signal line. Everything's been sort of flat for the PMO, and I don't look at that as necessarily a negative thing. It measures acceleration, and if you have even acceleration on your rise, you're going to end up seeing the PMO flatten just a little bit. What does this look like in terms of the bigger picture for Spotify? That breakout, it doesn't really match up here with any of the previous tops and bottoms, but I would probably go about here. Whoops, I don't want to have that. I would probably look around here for the next area of overhead resistance. I'm matching it just with the low over here and that top that we saw back here in October. But I think Spotify is looking really good right now. The other one, I was going to look real quickly at SunPower. It was another upgrade, and you mentioned it, Tom. Just a quick look at this. It was upgraded today, on its way to the moon at this point. And if you look at this in terms of previous activity here, you can see that it's still breaking out. It's now covered up the gap that we saw all the way back here in June. And then I'm going to look at one downgrade for you. Macquarie downgraded US Bank Corp from an outperform to a neutral, and they have moved their price target to $59. So that's right about here. Leave that up there. So that's what they're looking for on US Bank Corp. And, it's also been making a great move out of that December low. And, that breakout above that longer term resistance area looks very promising. So I thought that one looked good as well. And that's all I have for upgrades and downgrades. Here are the list of those. And we will be right back with Roman Bogomazov after this.
a live show? Want to rewatch a workshop? Tune into the StockCharts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have Chart School and creative strategy videos to help you become a better technical trader. Leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.
Hello, everyone. I'm so happy to be here. Tom, Erin, thank you so much. Today, as usual, I'm just going to give the market update. And before that, really quickly going to go through some of the offerings that we have. The big one that we are having is the Best of Wyckoff conference. This is the conference that we've been hosting for the third straight year. It's online and on demand, so you don't have to be there. It's on September 2nd. It's a Labor Day. And we have such a collection of Wyckoff talent throughout the conference. I'm not going to go into all of the presentations. Just go to our website, wyckofanalytics.com, check out the schedules, check out the presentations. Also, we are offering on September 9th a free webinar, or the first class of the Wyckoff trading course. On August 28th, a free webinar on the Wyckoff market discussion. This is the session that I conduct with Bruce Frazier. And also wanted to mention that we've launched quite a few blogs over the summer on different Wyckoff topics, including cryptocurrencies, scanning, trades, campaigns. So go check it out. All right, with that, let's move to our market update. Well, I usually start with this slide. Kind of want to give right away the perspective on the market itself. So, and perspective on different time frames. Long-term trend is still up. If you have a question about the scale here, go create an arithmetic scale and you still will see that we are still uptrending. In the intermediate trend, we're still in the trading range by far. We are touching all of the resistance points right here, and this latest reaction, this is just another attempt to go up. By the way, look at this. We tried to go up once, we tried to go up twice, and now we had enough momentum to overcome that. The price did not came back into the trading range right away, which is a bullish sign. And look how much time the price is spending above the resistance that was created by the previous high. So that's also a bullish sign. Short term, I think that we are in some kind of trading range here, maybe upsloping trading range. The short term, there is really nothing to worry about. We don't see a lot of distributional qualities in the way how supply comes in. Even yesterday on the news, and I don't have today's date, today's update on the chart. So this is yesterday. But supply that's coming yesterday is not in line with the effort that was shown to us in October. And also, the result is not as great as well. So again, a bullish indication. Also wanted to point your attention that, as we've talked a lot about this rally right here, we saw the momentum kick off. This is the rate of change 21. And then look at this, just recently, even on this smaller rally, we still have some buying behind this rally. So again, there are quite a few bullish signs. And I keep telling my students that I don't see anything distributional now. It has to be a break in the price structure, which is significant break, and it also has to come with a lot of volume and a lot of supply, where we see institutions that's selling in bulk. All right, let's go to the next one. This is something that maybe you've seen from me as well. This analog that I'm showing here is from 2016. We had a rally after the decline of almost 15%. The rally that has been very momentum driven off the lows in January, February of 2016. Reaction, which reminds me a lot of what we've just had recently in May, and then an attempt to rally. And again, we are rallying here. So this is a very good established analog for us. So let's see what happens afterwards. All right, so in 2016, as we rallied, we are going into some kind of localized volatility event. That was Brexit, and obviously that was a huge event. But we could analog this and we could expect that some kind of possible short-term volatility should come at this point. And it seemed to me like yesterday, and I was preparing for yesterday, was the trade, I'm going to show it to you in a second, that Fed could be the reason why volatility, or rather Fed's decision could be the reason why volatility, local volatility can come, and you could take advantage of that. Well, before we go on into the actual trade, I want to point your attention that in 2016, when we went into this pattern, we actually stayed there for some time. We stayed there for almost 6 months, and we just had, deviation around the mean. Obviously, two events, the Brexit and the election, were on the agenda, and the market participants were just waiting for the results of it. Well, we have quite a few catalysts where that we are waiting on as well. Tom has mentioned at the top of the session, Fed decision. Are they going to cut again? I kind of agree. You either cut, 50-point basis and, just send this message, a stronger message to the market that we're so accommodative and we're looking into the inflation, rise of wages, and so on and so forth. We also have a lot of uncertainty on tariffs, China, so that could lead into some kind of trading action where we might have localized increased volatility both on the upside and to the downside. So I think it's going to be a challenging market going into the end of the year, especially into the seasonal low of October, November, and therefore, adjust your strategy. So what was my strategy yesterday? And obviously, as I was thinking about this strategy, how to execute on that, how to make this trade, I was thinking about this, even a week prior, anticipating that on Tuesday, Bank of Japan is going to have the rate decision. Then on Wednesday, US is going to have the Fed decision, and then ECB on Thursday, I believe. So I thought that by itself is going to create some kind of volatility, and we are going to have an opportunity to trade volatility itself and the direction too. So the question was for me, was this trade is, what am I trading? Am I trading direction of the volatility? And I decided to trade volatility. So I typed my entry on the S&P 500, and I'll explain why exactly, this entry happens here. But I'm buying actually the calls on VIX. And that trade worked out. I was not really thinking that I'm going to hold on to this trade for a long time. I thought that the maximum duration of this trade might be a couple of days, not weeks, not months. I was just expecting a local volatility. And that's how it came about. After the decision, we have a decline, very sharp decline, and volatility just increases. Volatility increases and the value of the VIX goes up. And you don't want to overstay here, especially when you see a demand tail like this, where you're thinking that this demand tail represents institutional buying. The reasons for that trade were expectation of the short-term increase of volatility, catalyst with Fed decision, technicals, diminishing upward thrust. So we could kind of see after the climactic action, every time the price goes up, it stops, it stops, it stops, it stops, it stops. So that thrust to the upside was diminishing. And then obviously increase of volatility inside of this channel, inside of this trading range shows some signs of weakness. So after the break, it was kind of an easy entry point, and it was close to the catalyst. Well, let's talk about other market analogs, and I always like to bring different analogs. This one is going to be the analog on the Fed funds rate. So, Tom, you might like this. This is the data, economic data that spreads out, throughout each month in 1994, 96. There is a great analog which I think that we should be exploring. From 1995, 1996, we had a rise in the Fed funds rate by that time, and then suddenly the Fed decided, yeah, we're going to cut. What were the reasons for that cut? So I went and I read some of the material about that area. Would that surprise you that the main reason was the economic slowdown, or the worries, the doubts that the economy is not growing well? And I mean, look at the GDP growth. This is really dismal GDP numbers. We obviously were in a slightly different environment overall. We had high Fed funds rates, we had high unemployment, we had high inflation. But the pattern, the technical pattern was the same. It's the rise and then the cuts. So what that produced, and by the way, they cut not only here, but they cut here as well in 98, and that was associated with the Russian default. What that did is that produced the short-term liquidity that allowed the market to run away in 1999 and into the 2000 high. And then we could see that the Fed, as always, late to the party, as always, trying to catch up. So I'm thinking about this analog just because of how the Fed is acting in the similar conditions, or at least in a similar worry state of the possible economical slowdown. Let's look at this from slightly different perspective. In 1995, the last rate hike was in February, 50 basis points. And then in July, they started lowering. Then they lowered again. Then they lowered again. So we kind of, should send a letter to the Fed and say, you've done this already. Maybe something else. Be more aggressive. Be more decisive. But at the same time, we should look at this as an opportunity. Opportunity for what? How would we trade these markets? Well, let's look at the markets in 1995, 96. What were they doing with this type of the conditions? Well, we had a pre-election year rally in 1995. That was one of the best rallies historically in general. And it kind of has that momentum characteristics that we could say are similar to the rally that we had since the lows in December. And then look what happens next. Going into the election, again, something of an uncertainty, some event that market anticipates. We went into the trading range, and this is going to be my whole premise for today's presentation, that we possibly could go into a trading range going into October, November, and maybe even into the end of the year. There's just too many things that kind of point into that. Well, let me show you what else I'm looking at. And by the way, here on this chart, look at 1998. That's when the Russia default crisis unfolded. They were lowering, and rightfully so, because they needed, to pump up liquidity at that point. But look at the structure. Does this remind you of the shakeout that we just recently had? And then look at this structure right here. It doesn't look like a structure by itself, but if you look at other indices, and specifically at the one that was always a growth in the growth department, Composite. Look at the structure in 97, 98 here. This seems like one structure. It doesn't look like two separate structures. Those are just, local three structures that define a much larger structure. So what do we see here? Well, the final shakeout, and that reminds us so much of the structure that we just had recently. Going into phase C. This is the final C in Wyckoff methodology, where we are testing the previous lows, and usually we are going to have a lot of volatility going into phase C. This is where the value and liquidity are going to be found by institutions, and on the rate cuts at that point of time, imagine how much liquidity was given to the market, and that's what happens after the liquidity is there. We have a very big momentum rally. Just going through the analogs here, big run up, change of character, absorption for the next rally, some pattern of the distributional pattern at the top above the resistance. Please note how much time the price spends there above, suggesting strength, and then localized distribution, and then a shakeout. So everything kind of matches very nicely. And obviously the rally, I mentioned the rally. Look at the duration of both. The trading range, kind of the same duration for the rally. And then what happens next in 1999? Well, we are going on the composite into a trading range. This is a trading range. It's just upsloping structure. It's not horizontal. And that trading range has lasted for 9 months. So that's another idea that I have about the way of how the market might be unfolding into the end of the year. We might have new highs, and they will be advertised by the news media. But at the same time, we will not make a lot of progress to the upside. The more defined bias, we're still gonna, go up and down, consolidate. And therefore, I'm suspecting that we might have some kind of sloping structure, or we might have a scenario that we had in 2016. If that's the case, well, what's going to happen next? And this is something unusual for me. I don't like to make, such long-term predictions, but this is just too much fun, so I can't resist it. This is the 1996 analog, so think about this. We just had a rally, then we go into the trading range, and then into the election we go again into the rally. And in 1999, a rally, a trading range, and then a speculative run. And this is a very interesting idea that we've developed together with Bruce in WMD class just recently. It seems that the market, after some of the uncertainties, it's going to be gone. And after more liquidity is going to be added to the market by the Fed. And they probably will do so unless they see inflation numbers improving, or commodities starting to rally more aggressively. But after that, after those uncertainties are going to be gone, and hopefully after the tariff resolution as well, I think that 2020 might be a very interesting year. It might be a very speculative year. It might be the year where the retail trader and investor are going to come into the market with a lot of force and a lot of money. And this is where big institutions are going to use this opportunity not only to mark up the price in the market, but also to dump some of the stocks into weak hands. And I wonder if that's what's going to happen. So this is just a projection. So how would we trade this? I'm going to give you several ideas. Some are ideas that I'm trading right now, and some of the ideas that are maybe controversial, and I'm still looking for the confirmation of those. Russell 2000, I think, is a really good potential market outperformer. Why? And we've just talked about this in the last WMD class. Look at the texture of this structure. It's very horizontal. There is not a lot of retracement off the top of the rally that we have had. We are retracing what going into the sprint, maybe 1/3 of the move. So this is basically nothing. Then look at the texture of the structure from the perspective of the downswings and upswings and the spread. What do we see? Do we see any significant selling? Well, maybe this bar right here, maybe this bar right here, maybe this bar right here. I don't see anything else. And even those bars are going to have some demand signatures behind them because a lot of them are just stopping actions. So you assume that there is a demand right there. So there is not a lot of selling here, but there is a lot of inactivity by institutions not to participate in the small cap space until what? Until the time when it starts to locally outperform. And obviously, the Fed red cards are going to help out small caps because, of the cost of business and the cost of borrowing. So I do have a position. It's a very long-term position. I'm looking into 2020, on options for this position. And looking at the swing counts, and I'm calling this not a campaign, but the swing count, 48 columns, all the way through, and the minimum maximum count is 193 to 203. So this would mean that we're going to make a new high in Russell 2000, and I think that that will probably come, into the first maybe quarter or the first 2 quarters of 2020. Why do I bring this up? Russell 2000. I think if the market structure is going to be such that we're going to have some trading range that is, let's say, upsloping, Russell has an opportunity to outperform. Excuse me. Russell 2000 has an opportunity to outperform in this environment, especially if the Fed is going to continue lowering the rates. So that's one of the ideas. What's another one? I really like semiconducting stocks. Look at their regional base that we've been in for years and years. This is the business cycle where semiconducting stocks have not participated in the market run up to the new highs. And usually there is this switch between the cycles. So we are currently in this cycle where semis are actually leaders. And what's interesting here is that we have cleared, and this is SMH, we have cleared a long-term resistance. And we are testing this resistance. We've tested it. And we are in the trading range right now. Well, look how volatility increases in this range. Usually we would say that increase of volatility is bearish. In this case, we're seeing that as volatility locally increases to the downside, we have really quick rebounds to the upside. So it's still leadership characteristics, and in itself, a lot of local momentum and short-term volatility suggests more participation by institutions. So I'm thinking that this is the theme that they've been favoring for quite some time, and they're still favoring it. And if we look at the PNF of this formation, of this reaccumulation, we have quite a few. We have quite a few of the room to go, over 200. 212 to 132 from, let's say, 100. That's almost a double. So think about that scenario of the rally in 1999 that produced in NASDAQ Composite a rally of 95%. So this is very close, almost doubling. All right, another idea, and this is something, I'm going to end my presentation with this, and you guys have a poll about oil. The first thing that is so interesting to me is the analog of the price structure from earlier years. So follow my logic here. We're looking at the declines in both cases, and then we're looking at the trading range that has lasted 5+ years. We, in 2008, 2009, we had an extreme oversold condition. Usually out of the extreme oversold condition, the first move is always going to be a rebound. But then you're going to have a trading range. So that duration of the oversold condition and the trading range was very close to what we had before. Then we had a decline of about 2 3/4 years, 2.5 years in our current structure, a move up, trading range for almost 2 years. Here we are somewhat close to that. another rally that lasts the same amount of time, a decline again, and then here in 2003, we are in the local trading range, going up and down, up and down, up and down. Remember the climate that we had, the environment at that point of time. We just made the final low in the market, and the market was starting to go up. So it's very interesting how this analog unfolds. What happens afterwards in 2004? Well, we had a rally of over 100% in 2003, 2004, since the lows here at about $25. Could we do it again? I believe so. Let's look at the PNF counts. And I'm only looking at this latest area. So the first count that I have goes to 77.84. The second count, a larger count, goes to 94.102. So that kind of confirms that, yes, there is a possibility, of a good run-up in oil. My problem with oil, and I do have a position in oil, which is a probe position. I usually do those probes to establish a position and to see if I'm right or wrong. I might be proven wrong on this, and this is a very long-term campaign type of the position. But the intellectual challenge about this chart, I think, is all in the character. It's not in the direction. And what I mean by the character is the character of the structure that might develop. There is so much uncertainty about oil right now. And as I read the news on oil, it's not even about what Iran is doing. It's more about the demand itself. Oil is very supply-demand driven market. And we're seeing that because of the economic slowdown, the demand for oil is not at its high. At the same time, there is a lot of supply coming out of the U.S., so that influences, how oil is being traded, how big institutions are accumulating this position, and so on and so forth. So I think that going into the end of the year, we're going to be threading waters, maybe with this slightly upsloping bias. And then after that, in 2020, and especially into the mid-2020, we might have some kind of acceleration to the upside. And that's conditional, obviously, on a lot of things. Tariffs resolution, and then hopefully China is going to pick up, the economic growth is going to pick up there. And then just overall demand for oil hopefully will pick up. So I'm not making this call, but it's just kind of like looking at this as an intellectual puzzle at this point of time and kind of probing these positions a little bit. But if you would like to trade oil right now, what would be the best trade or the best idea? Well, obviously, Tom and Erin have mentioned renewables, and I've been campaigning that particular group for quite some time. I actually do own SunPower. Since $6, $7 have been accumulating. So today was a very nice day, to have it on the earnings. But renewables are a little bit far ahead. They are in such extension of the trend and on the buying climactic action.
Hey, Roman.
Yeah.
I'm sorry to cut you off, but we are getting close on time.
Absolutely, yeah. This is the last slide, by the way.
Okay, just a couple quick things. Number one, at your earlier Excel spreadsheet I thought was outstanding, showing comparisons back to the late 90s, mid 90s, late 90s, and then following through with some of your calculations as far as targets go. I think certainly are presenting everyone with a lot of great ideas as we look ahead. I tend to share your bullish views, but as far as the poll goes, because we do have a poll.
Oh yes, let's look at the poll.
And so, are you? In that poll, are you suggesting that you think we'll be above the, what was it, $70?
I think that we're going to be in between 70 and 45. By the end of the year. I don't think that we're going to go above 70. I mean, there might be a possibility. I think that if Iran is too active, militarily, that could produce that anxiety in the markets, and push the oil above 70. But with all of the uncertainty about the demand, I think we're going to be in between 70 and 45.
Okay, well, we're going to go ahead and bring the poll up and take a look at it. see what everybody else thinks. And it looks like the majority agree with you, but we're going to stay in this trading range. I actually think the same thing. I think that we're going to see some economic strength that could be favorable for oil prices, but I think the dollar is going to continue to be strong, and I think that'll be a headwind. So I'm going to agree. I'm going to go with that 50 to 65. Erin, you have any thoughts?
Yeah, I was thinking the same. I was between the 50 and 65 myself. I'm looking at the $60 area as a finish to 2019.
Yeah, if I had to hedge, I'd go above 70. I just think that things will pick up economically around the world just because central bankers are so dovish. But I think the key is the end of 2019. We're only talking 6 months out. I can't see it going above 65 in 6 months.
I would agree with that. If I would bet directionally up or down, I probably would bet up rather than down.
Awesome. All right. Well, we do have to run. It is always a pleasure to have you on here, Roman. Great presentation. Gives everybody a lot to think about. And we'll have some ammunition next time you come back. We'll see what's happening at that point, see what the Fed's doing.
Sounds great. Thank you so much for having me here. It's always a lot of fun.
All right. Appreciate it. Thanks again.
Excellent. Well, you know what? We have a Talking Technically to show everybody. Arthur Hill's going to talk to us about divergences.
Divergences are covered in textbooks and they are meant to foreshadow a potential reversal, but I've found that you got to be very picky when you're looking for divergences, and most of the time you need to ignore them. So let's look at an example here on the chart. The problem I have with divergences, especially a bullish divergence, is it often forms when the stock is in an uptrend. So you can see here on this MasterCard chart, we're hitting new highs and moving higher, but MACD is moving down. Now you get this decline here, but it doesn't foreshadow a major reversal. And then we can see the stock continues higher and we have another big divergence, but it doesn't foreshadow a big decline. Now sure, I've cherry-picked this a little bit, but I think as a rule of thumb, when the stock is in an uptrend, we should ignore these bearish setups and focus on pullbacks and potential bullish setups instead.
Okay, welcome back everybody. And it is time now to jump into our 10 in 10. First stock today is Triton International. I mean, just looking at it quickly, it's been in sideways consolidation mode for quite a while. You can see its industry group has been one of the worst performers over the last 52 weeks. So I'm not going to be too interested in a stock like this. I'm probably going to be able to quickly dismiss it. But what I would look for maybe is probably short-term support down around 29, resistance 35.25. I would probably wait to see a catalyst, maybe earnings, something that drives the stock out of its trading range to the upside and gives it some relative strength. But I think until then, I would pass, look for something else.
All right, excellent. We had kind of a tie in the chat room with about 3 stock symbols, but I'm going to start us off with Square.
Love it. They report earnings after the bell tonight. And I think we're going to find out whether or not this relative strength over the past 2 months was because of a strong earnings report about to be released. But this is what I like about it. I like the fact that it has begun to outperform the financial administration space. And of course, financial administration has been strong overall, not just in terms of absolute strength, but also in terms of relative strength. So you got a great group. All of a sudden, you're getting a really nice relative move in Square versus the group. And I also noticed this big volume spike as we were making this new high up to 82.5. We're testing this area right now. It's either going to be a big disappointment in Square, or I think we go shooting up towards that October 1st high up near 100. I believe it's going to be the latter. I think we're going to see a good report out of Square.
All right. The next one, awfully popular, Bombardier, BBD/B.TO. So I'll give that to you again. Ready? BBD/B.TO.
All right. I probably could have done it on a different chart. Let me do it real quick. BBD/B.TO.
Yep.
Yeah, I mean, maybe if we finish with this hammer, that would be certainly a good sign in the near term, because you do have support right at about 196. You can go back even further, see a little support back in here. So if we can finish strong, we will have left a tail well below, which I think could be a sign of accumulation and a reversal. But overall, we've been trending lower. So I'm not really that excited about the stock to begin with. So I think even with a reversing candle, I don't know that I would trade it. So I'm going to pass.
All right. The next one up is one we actually talked about before the show, KTOS.
Yep. I tell you what, for every one of the stocks that look good heading into earnings and move higher, you have some that don't. And Kratos is one I would have sworn that we were going to go higher on. They actually did beat top and bottom line. And what I say is usually when they're strong on a relative basis, that they're going to beat. What they maybe didn't tell Wall Street is that they were lowering the revenue guidance, and that's what happened today. Now, there's a couple things I'd watch here on this one. I didn't like the gap down here. Actually, I own this one and did hold it into earnings, unfortunately, and so licked my wounds pretty early. But you can see it has come all the way back down below this low and is trying to reverse. If you're in this one or thinking about getting in this one, you really want the reversal, and you want it today. You want it this afternoon. I think that this is a key area of support. So if we can reverse above, head back toward that 22, 23 level, I think that gives it a little bit more hope in the near term.
All right. So could be an entry lining up here.
Yeah, but it's a risky one. So I'd probably keep a stop in below that earlier low today.
All right. How about Microsoft?
Mr. Softy has been extremely strong, trying to make another breakout here. It's a over $1 trillion company. I think it's still got the highest market cap among the FANG stocks. And although Apple with the big gap up, I'm not sure, but I think Microsoft still got the lead. But it's in that software space. It's hot. The company is doing a great job of reinventing itself, has been for the last few years. And so I think it looks really good. I'm a big fan of the software area, and you can see Microsoft doing extremely well on its own chart, but also on a relative basis, starting to pick back up again. I look for another relative breakout here. Microsoft looks good.
All right. In that technology space as well, Diebold Nixdorf, which is DBD.
Yeah, another nice gap up. I mean, it's a little uneven, but it could almost be a cup and handle. This one a little higher than the left side. But I love the volume coming in. We did go through a period of consolidation right here, and you can see the stock was outperforming its computer hardware peers. And then when we consolidated, we lost a little bit of that relative strength, but look at what's happened. We've just broken out again above the relative highs. So we've broken to 52-week highs in both absolute price and also relative price. So I like it. I think this is a stock that's poised to go higher.
All right. In the materials space, Kirkland Lake Gold, KL.
Yeah, the Kirkland Lake we've looked at quite a bit, but this is one that I would if I was going to be in gold, this is one I would consider. I don't know. I'm assuming there was maybe a negative divergence here that could have led to this 50-day test and the test of price support. I kind of remember annotating this one and talking about that 40 level, that I really would want to make sure that that 40 level held right there. Gap support on this gap up as volume increased in the third, fourth week of June. Pullbacks held 40. And then I think we might have even had a negative divergence with that new high. So I wanted to watch that $40 level pretty closely, but I'm going to pull that up also on a chart with a PPO, so I can just take a look at that. And you can give me the next one while we're doing that.
Sure. CELG will be next.
Right,
Breaking out.
Yeah, there is your negative divergence, by the way. Higher prices, lower PPO. So what I look for is a 50-day test and a center line test. We've got the 50-day center line. We're working our way back there, but I would really watch that $40 level for sure. All right, CELG. Well, first of all, it's in the biotech space. We know that. It has been struggling here over the past month to maybe 6 weeks or so. On a relative basis, it was at a nice high in June, but has pulled back. And of course, we know the group has been awful relative to the S&P 500. So if it's been a bad group and the stock is trading below both of its key moving averages and the 20s below the 50, I've got to see something take place before I'd have any interest here, because I don't want to be in a downtrending stock in a downtrending group. So I think probably at a minimum, I would need to see a move back up above 95. Until that happens, I would just pass.
All right. This one was requested by quite a few. Etsy.
They report after the bell tonight, so keep that in mind. Looking at it, it's been downtrending on a relative basis for the last 5 or 6 months, but the group overall has been very strong. Now we're starting to see a little bit of a turn back to the upside. I'm kind of on a fence here with their earnings report and what we're going to see. But what we want to see, if you're in the stock, and what I would love to see, is a gap up tomorrow and an open above this level right here. So you want to see it open above about 73, 73 and a quarter. If you get that, I suspect it's the start of another leg to the upside. You have another one?
Yep, we have Keysight Technologies, Keys.
Yeah, this is another one that I think is just waiting for a big move up. Look at the relative strength here. Very strong versus its peers. I think you've got a nice little cup, sideways handle here. So I just think we're waiting for that confirmation on a breakout. Relative strength is awesome. There is the area taken from this high. You can see all these tests. I mean, you could say cup, handle. You could say equal highs, rising lows, ascending triangle, whatever it is, however you want to look at it. But they're bullish continuation patterns that are confirmed with a breakout above, say, $94. So watch for that.
All right. That was the 10 and 10. And here are those symbols. I will have them up in the MarketWatchers Live chart list at the end of the show. So go ahead and go to the articles tab, click on the MarketWatchers Live blog, and the link is right there at the top.
All right. Well, we have the market right now. Dow Jones is up 259 points. You can see here, right?
Yeah.
Not quite to the high of the day, but close. NASDAQ up 117, the S&P up 28. Russell lagging a little bit on a relative basis today, certainly well below what we're seeing on the NASDAQ, but still up 7 points. It's got that 1580 to 1620 area that it needs to negotiate. And I know Rahman was talking about that earlier, that he really likes the Russell 2000 going forward. And if we get through 1620, I think that's the confirmation. I would definitely agree with that.
Yes, absolutely. And, looking at a relative chart too with the Russell 2000, we're finally coming off that relative low. It looks like we're finally starting to make that move.
Yeah, and that's kind of an interesting chart too, because I'm going to go way back on this one. Maybe this will be the final thing we look at here. But if you go back, and I'm going to set it up for, let's go back 20 years, and we'll do a weekly chart. Of course, we don't need candlesticks. That's just confusing. But if you look at this, we are at a really key area. Going back to the first quarter of 2016, 0.52, going all the way back to 2008, 2009, this 0.50 to 0.52 area has held for about 15 years. And that's where we're testing. So if we're going to get outperformance by the small caps, it probably is going to happen from this level. And I think that trigger is a move through 1620. It's something I'm going to be watching really closely.
Absolutely. Have to agree with that.
Yeah, if you look at the price chart here, you can see, that we're in an uptrend. I could connect these lows here, and I know the Russell 2000 has been feeling really bearish, but it is in a confirmed uptrend. And I think if we get through that 1620 area, this is going to take us back through what could be a little bit of a symmetrical triangle as well, which is a continuation pattern off of an uptrend. So I think things are pointing up for the small caps, but I want to see that breakout first.
Absolutely. I have to agree with you. That is the critical area for sure.
Yeah. So, we got about 10. No, actually, no, we don't. We're this week. We do have a great upcoming schedule, though. I'll be talking about seasonality tomorrow. And look at that list for next week. You'll definitely want to stick around and see MarketWatchers Live next week. All right. I want to thank all of you for being with us today. Thanks to Rahman for his great presentation. As a quick reminder, MarketWatchers Live airs 5 days a week, Mondays through Fridays from noon to 1 p.m. Eastern. Have a great Thursday afternoon. See you tomorrow. Happy trading.